Hey, Mike Meilinger. Excited that you're here watching this video. Want to talk to you real quick about business valuation. Generally, you've reached out to us about a business valuation for one of three reasons. The first reason, the most common reason we get engaged, is you're in marital litigation or divorce and you need your business valued. The second reason is for gifting purposes, right? Your attorney wants you to gift a portion of your business either to a trust or to some children, and you need that business value. Closely related to gifting would be estate purposes, i.e. someone has died and they owned a business and you need it valued for the estate tax return. This is generally less common because of the size of the estate exemption. The third reason is you're looking to sell your business. Either someone has reached out to you about buying it and you want to see if they're offering you a fair price, or you want to come up with a fair price, or you want to sell it internally to your key employees and you're trying to come up with a price for that, or you're just contemplating taking it to the market and need to know what you're going to do. With that said, I'd like to talk about the business valuation process in general. In general, every business valuation, full business valuation, is going to include three methods of valuation. The first method is what we call the asset approach, and the asset approach is the easiest approach for everyone to understand. What we're going to do is we're going to take the fair market value of your assets and subtract the fair market value of your liabilities. The difference is the book value of the business, and the book value is generally what we consider the floor. In most cases, that's going to be the floor of the value, i.e. the fair market value of the assets is $3 million, the fair market value of the liabilities is $2 million, the book value is $1 million. The second approach is the income approach. The income approach is where we look at what we call a hypothetical buyer, and what a hypothetical buyer would require as a rate of return for the business. So first, we're going to calculate the rate of return required for the business, and the smaller and the more riskier the business, the higher the rate of return that the hypothetical buyer would buy. Then we're going to value the income stream, and we're going to come up with the income stream generated by the business. And the income stream we use, what I like to tell small business owners is, hey, if you ran the business to make the highest amount of taxable income possible to impress your shareholders and get the stock price up, that would be the business. So what we're going to do is normalize the income stream, look at the shareholder benefits and different things like that, and come up with an earning stream. You take the earning stream, you take your capitalization rate. There's all sorts of other methods you could do using this type of approach, but you're going to come up with the value. The third approach is what we call the market approach. And the market approach is what we do is we find similar businesses to the one that we're actually valuing, and we look at what they sold for, and we come up what we call multiples. And a multiple, one that most business owners understand that's commonly used, is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortizations. So that's a common multiple. So you might look and say, hey, this business sold for 4 times EBITDA. It's very similar to this business, and therefore we're going to look at that valuation multiple. Another multiple that's real common, this is with the smaller businesses, what we call micro businesses, is seller's discretionary earnings. Again, we're going to add back everything that the seller's pulling out of the business, come up with the EBITDA number first. Then simply you add the salary of one of the business owners to that earnings stream, and that's seller's discretionary earnings. And seller's discretionary earnings could be multiples from 1.5 on the low end, or 1 sometimes, counting on the risk of the business, to the highs of 3s or 4s. But that's generally where you're going to look at these micro businesses, okay? So those are the three methods of valuing a business. Now, the methods we use are going to be dependent upon what the owner is looking for. So I'm going to start out with the lowest price. If you're just looking to sell your business and you just need us to consult with you, a lot of times what we'll do is we'll just pull market compilations or market multiples. We'll look at your business, we'll come up with an income number, and then we'll talk to you about the business and we'll consult with you on the price. The second level of business is what we call a valuation calculation. That's where we agree on the procedures that we're going to use to value the business, and we proceed and we value the business, and that report is limited to a shorter report than the third, which is a valuation report. A full valuation report, we are required, since we're members of NACPA or members of the AICPA, and we have to do the report to a certain standard. A valuation report also has to meet IRS standards. So to give you an idea, so we talked about valuing the businesses for purposes of selling. Usually we're going to do a consult or a calculation. And the consult and the calculation and the report, they can build upon each other. A lot of times people will start with a calculation and then ask for the full report. I'll explain more of this when we talk about marital litigation or divorce. On gifting, if you are gifting the stock or if you need a valuation for estate purposes, you're always going to have to go with the full report. And the reason you got to go with the full report is generally that report has to be included on your return that you file with the IRS. And the IRS really frowns upon people sending a calculation report or even a consult report, specifically for valuations of company, because the IRS has pretty strict standards on what we have to consider in the valuation, and we have to go through, not to get too complicated, Revenue Ruling 5960, and we have to mark all the boxes on that valuation and meet the IRS standards. Now let's talk about when a calculation is used. The most common time we use a calculation is in the beginning of a divorce. A divorce is where we're going to talk to the business owner or we're going to talk to the spouse, and we're going to come up with a flat fee to do what we call a calculation of value. And the calculation of value is going to be it's going to be a detailed calculation of value just in case the case doesn't settle. And we'll talk about that later. But we're going to look at all three methods of valuing the business. We're going to possibly give you a 1 or 2 page report, and the report can be used in mediation to settle the case. And because we follow pretty strict standards on every calculation we do and every valuation we do, our calculations about 95% of the time can settle the case, or can actually get the case where it can be settled in mediation. Now, let's say the case doesn't settle because of either someone saying the valuation is too low, or you can't agree on other items like alimony or different things, and you're going to go to court. Well, then the second stage of this divorce calculation is going to be where we're going to upgrade the report from a calculation to a valuation report for litigation purposes. We're going to meet all the standards of the report, and generally we're going to give you your report at a flat fee, at an additional flat fee. Generally that runs, counting on the complexity of your business, between $2,500 and $4,500 extra to get to that report stage. Also, one thing to realize is we will also have to probably charge you hourly, or we will charge you hourly to testify in court, to meet with your attorney and prepare for court. Again, I want to tell you that over 95% of the cases we work on settle, and that's our goal. That's where we feel like we create value in the divorce process, by doing things correct and with a standard approach. So thank you so much for listening to this. Hopefully you have a great day.